Today we're digging into The Golden Rule of Investing, a 2023 paper by quantitative researchers Pin Van Vliet and Harold Laura. They ask the following question: is gold a safe haven investment? Market history is littered with brutal drawdowns in the stock market. 2002, 2008-9, 2020's pandemic crash. Protecting against those hits is the fastest path to long-term wealth compounding. Thus, you want to have assets that can be labeled safe havens in your portfolio, which gold presumably is. We summarize the paper and we backtest a portfolio where we allocate capital into gold. Can inclusion of gold in the portfolio mitigate risk? The authors looked at data from 1975 when gold became freely traded until today. They diversified from stocks and included a small portion of gold. What was the result? A small slice of gold, about 5 to 10%, inside a classic stock portfolio does reduce downside risk, but it also shaves returns. Think of it as buying insurance and paying a premium. To see how that thinking played out recently, we ran a simple backtest from January 2005 through May 2025. Portfolio A, 100% S&P 500, SPY. Portfolio B, 90% SPY, 10% Gold ETF, GLD. During this period, the portfolio performed better at both metrics by allocating 10% to gold. The annualized return increased from 8.2 to 8.6%, while also max drawdown went down. However, this is a period when gold happened to do well, better than the previous 20 years. A modest gold allocation helped, but the real takeaway from the paper is that low volatility stocks would likely have delivered an even better risk-adjusted outcome over the same window. What are the conclusions from the paper? Gold's safe haven story checks out, but the insurance premium is lower returns. Low volatility equity factors give more downside protection per unit of return, sacrificed, essentially a cheaper hedge. If you found this breakdown useful, give it a thumbs up, share it with a friend who loves gold, and make sure you hit subscribe so you never miss our next research deep dive.